Hello, YouTube. Welcome back to this dividend portfolio. I'm going to be going over the portfolio today, and it is October 20th. So we are two-thirds of the way through the month, and we're going to look at the dividend payments from this month. And just a reminder, this is not financial advice. This is just one part of a larger portfolio. This is just to show how a dividend strategy can work. This is focused more on dividend income rather than something like dividend growth or value investing, something like that. So, um, we are at October 20th, like I said. In this column here on kind of the left side, we've got the months for this year. We started this mid April. We've got the grand total so far for the whole account. This is just dividends, is $855 for us starting back in April. So I think we're going to hit that $1,000 for the year. This chart on the left is the grand total so we can see the growth over the months. This is again the total. This chart on the right is the dividends per month. I've gone over before. See, we have this $105 dividend. That was in August here. That was in like a really risky position that I basically broke even in, and so this one I'll make it like orange or something. We're not going to see those again, but that's for good reason. And so from July we had $125. September we had 173. We have this big bump in August from that $100 dividend. This curve on the right side would look a little smoother without that, but we're kind of back to normal for October. Normal being we're still growing this. I'm still buying pieces of these funds, and we're watching the dividends roll in. So far, in the yellow here, these are the actual dividend payments in the accounts. I'm just kind of doing this quick and dirty. I'm not putting the date on everything. I showed, where these come from and stuff, but we've got a $28, a $12, a $32. Those are some nice juicy ones. And these are coming in through the week. $7, $6, $17. These are coming in throughout the week. They buy back into the funds. At this point, I'm not really doing dividends back into cash, which is an option if someone wanted to do that. There's little ones, 18 cents, 37 cents. Here's $33, $14, 129, and then a 19 cents. And this is today is October 20th. So we have 10 more days left in the month. Our total so far is 234 just for the month. So this chart at the bottom right is kind of growing and going up to the right, the total for each month, which is amazing because we've actually passed August with that huge $100 dividend already, just by a couple dollars. And if this keeps going in this direction, I think we should get close to $250. We have 10 more days for dividends to come in, and I think we're going to get close to $250 by the end of the month, which is awesome. So I'm going to pull up the calculator, and one fun thing about doing this dividend income thing is, with at least with Robinhood, you get little alerts when these dividends come in, and it's just very psychologically fun in terms of investing to watch those hit your account. And it's motivating to be like, okay, yeah, I want to buy more. I do have some auto buys on to kind of take the also to make this easier, right? Like if you put on auto buys, then Robinhood is just automatically buying the funds, and I'll go over the main funds in a second. But going back to the calculator, so if we do hit 250, um, then we should hit that for November and December again. So let's take our total 855 for the year so far. Let's do plus 250 for November and plus 250 for December. So that puts us at 1,355 by the end of the year in dividend payments. Again, this money is just buying back into the funds, which is supposed to create a snowball effect. We want to buy assets that pay us back. This is one passive income strategy, you could say. I did talk to somebody that's very into the real estate passive income thing. I think it's less passive in the sense that if you do real estate rental, there's a lot to manage. Plus, I mean, we need, people do need to rent sometimes, but people owning all these homes and renting them out and stuff, I think this is just cleaner, easier. We do have to pay taxes as part of our tax bracket on this at the end of the year as well, so we have to plan ahead for that. Um, but another fun thing we can do with the math is, so this should be close to our total for by the end of the year. But let's say we just stopped buying and we just did 250. What we're going to average 250 a month, and then we'll do times 12 months. So next year, if these all stay steady, next year, if we stick to the 250 a month, we should bring in $3,000 by the end of next year. If this $250 is an average and we don't buy anymore, and $250 a month, that's looking pretty good. That could be auto insurance payment. That could go towards rent, something like that. Right now, we're just continuing to buy back into the assets with it. Another thing I like to do is say, well, what if we, did times 6 months? That's $1,500 in a 6 months period. That could be a vacation. That could be whatever I wanted to do with it. But for the long term, I'm just buying back in. But I like this passive income strategy. So let's look at, these are the major holdings, and I'm going to kind of do this in two parts. I'm just going to show you guys them, and then I'm going to show what the dividend yields are on these, like we do sometimes. So you can stop here if you're not interested in the yields, but these are the major holdings: JEPQ, SPYI, QQQI, GPIQ. There's one called JEPI, SCHD, SPHD. These all do slightly different things. Some of them are very overlapping. Some of these are in different categories. Part of this is just to have some diversity. There's JAAA, there's JBBB, SPYT, CLOZ, which is very similar to JBBB. It's just a different company. And then my two risky ones that I still have, less risky than the other one, but there's YMAX and ULTY. And I can break these up into riskiness categories. Typically, they follow the yield. But this is everything that I've got going right now. The green number, this does not include the dividends. So maybe at the end of the year, I can break all these up. I'm not doing that right now because I'm just kind of doing this as like a quick and dirty overview. Some people track the dividends for each individual holding, and maybe I'll just add all that up at the end of the year. Not really that interested in going like that nerdy with it. But this green number is the growth of the actual, all the shares in that fund. Doesn't exactly reflect the dividend. So, for example, this CLOZ that I hold, it's down 0.42% on everything I have. But if I were to add the dividend payments from that, and this is the one I've held the longest, it will be up probably about 5%. But this number isn't calculated that way. And there is some criticism that Robinhood doesn't do that for you. It's going to be more important for these riskier holdings, which, this is down 6%, this is down 7%, but the yield on the payments is larger. So, like I know Alti, even though I'm down 7%, um, the I already added up YMAX, so that's a little easier. So these are riskier, so that's why I am diversified into all these. I did add up YMAX, so it's down 6.81% on the year, which is down $79. But the total dividends I've been paid so far is about $110. So I'm slightly up, and if this drops a huge amount, I can be in the negative. And I do know there's different ways to do this where you just take everything cash instead of buying back in, but that might be it's just another strategy, maybe for another day. So that's everything, and you could stop here. I will show the dividend yields for all of these, so you can also see the spread on that, and you can calculate like the average amongst all of them. I'm not going to do all that today, but if you want to know the yields, I'm going to do that next. So see if I can bump up the font size here in this column. Hopefully it won't move too much around. Let's see what this does. Okay, cool. I think you can read that. So, it's this one. Okay, cool. So from here, I'm just going to look all these up, and this is what we've got this year so far. So the first one is JEPQ. JEPQ. If you know some other funds that I don't have that I should look at, let me know in the comments. Maybe I'm missing something important. So this is this on Yahoo Finance. I can look at the 5-year return, stuff like that. And I'm interested in this yield. We know in dividend investing we can't only concentrate on the yield, because the yield kind of they're paying out from the fund, so you get this thing called NAV erosion, and you can look that up. And then we also have to consider the expense ratio, which is basically minus off of the yield. But just for this quick summary, I'm just going to kind of average these. So we'll call this 10.2%. So 10.2% for JEPQ. This is for the whole year, right? So if you held some shares for the whole year, it should pay back that 10.2% of all your holdings over the whole year. So if you want to know per month, you have to divide that by 12. The next one is SPYI. SPYI. This one is 11.71. Expense ratio is 0.68, so I'll just call this 11. SPYI is 11%. QQQI this is 13.6 minus the expense ratio. We'll call it 13%. So when these are up, if I didn't hold this for the whole year, but if I did, I'd have the 13% yield plus the 6% growth, which is pretty cool for this one. JPIQ, or not GPIQ is a NASDAQ one. The yield is 9.6, expense ratio 0.29, so we'll just call it 9.4. These are all percentages, right? 9.4%. JEPI. JEPI. And JAPI is 8.37 with the expense ratio, so we'll call this 8%. Move this up a little. SCHD, these two are a little bit more focused on growth than the dividend, so we should see a lower dividend. SCHD. Exactly. So the yield on this is, we'll call it 3.7%, much lower, but it is supposed to grow in an up market a little bit better. And I bought these way later in the year. But it's still nice to see the dividends come in on these and buy back in more shares. SPHD. About 3.2%. JAAA. So this is in a category of like business loans, AAA rated. This will be kind of a medium yield percent, but this should be one of the most stable holdings as far as the chart shouldn't really go up and down a lot. Um, you're going to see some things like COVID lows, and this was like tariff stuff, but during normal times it should be pretty even. And even the high is like $51, and generally like even these lows come in around $50. So there's not, even though it looks like this chart is moving a lot, dollar wise it's not moving a ton, which is what we like for the stability. We'll call this 5.4%. Should be one of the most stable. So even though it's down 0.24%, if you hold this for a year, this number here might not reflect your actual like total return. Because yeah, if this brings in $100 of dividends, but it's down $4, the $100 dividend payments aren't reflected here. SPYT. So this is a 20%. It's a higher expense ratio. We'll call it 19%. We'll minus the expense ratio off. We'll call this 19%. This is getting into a riskier one. Has the potential to drop more, but even if this dropped 10% over an entire year, the 19% dividend is still making up for the difference if that were the case. JBBB. So this one is minus the expense ratio about 7.2%. This one and the next one should be very, again, pretty stable. You're going to see some movement on the chart, but it's staying in a pretty good range. Not a growth one, but more of like a stability type of diversification. Then we have CLOZ. The 5-year should stay kind of in this range. It did have a dip for the tariff, but should stay about in this range. We're not going for growth here. We're just going for the dividends. We'll call it 7.4%. And the last two are the highest risk ones. I really like the SPYT. It's doing really well with that 19% per year dividend. This is turning out to be one of my favorites. And So then we have these much higher risk ones. Those of you that know about this stuff may already know about them. So Y max, and you'll see that risk reflected in the dividend. So for me, let's see, higher expense ratio, we'll call this 65% yield. So that's a 65% if you held it for a whole year. Um, and, you know, these are higher risk. This has trended down over the last 2 years. It's trended down 36%, which is still not as much as the yield. So if it went down 36%, but the yield is 66%, you may still be up 30% with the payments um, over that time period. And let's see. And then, so I'm down 6%, but if I held it for a year, I'd still be ahead. And I did do some of the math on this one. And then my worst performing one is ULTY. But again, yeah, this is a huge 65%. But these super high dividend per year, you need to be aware you're trading risk. You can't just go off of just a percentage, which is why you want to be diversified. I personally, I'm not trying to go all in. I've seen some things. People are like, I'm just all in on YMAX or all in on ULTY. I think that's pretty high risk. ULTY, last one I'll go over. And with the expense ratio, we'll call it 120. We'll call it 121. So if you held this for a whole year, it should return 121%. Can I change these to percents? Probably. Oh, it just went like that. Okay, never mind. So these are all percentages. 121% return if you held it for a whole year. I've held this one pretty long. I've bought more shares, and so yeah, if this drops more and I'm down 10% on the year, but I held it for a whole year, I'd still be way ahead with the payments. For these higher risk ones, I've read some people just go straight into cash and they use the cash to buy other assets, which seems like also, a decent idea. Right now, I'm still using this to buy back in, and we'll end up seeing how this goes. This is the whole point of this, is to see how this works. Um, it's possible to concentrate more into certain funds. Why? This is a nice juicy 13% return. Why not just go all in on QQQI? And the reason is because, well, for me, I feel like there's two reasons. One is I'm diversifying across these to manage some risk rather than just holding one single fund. The other thing, and like I mentioned at the beginning, is it's psychologically great to see these different payments hit the account on different days of the week, seeing them come in on the week. Some of these only pay once a month. So if I only had QQQI and it only paid one day out of the month, there would just be one payment here. And I would not get the psychological effect of seeing all these hit throughout the weeks. And for where I'm at, I am still okay liking to see all these. So by holding all these different funds, I get all these variety of payments. And math wise, maybe not the perfect solution, but I'm currently still okay with that. And as I find, I haven't even been doing this a year. As I find ones that are working better for the strategy that I want to do, um, maybe I will start shifting things more into certain funds that I like more. From what I'm seeing online, that's even pretty common for people to start. I've seen people share some accounts where, what do I have here? Like, let's see if this will tell me. This doesn't say. Okay, this says I have 13 different funds. I've seen some people try to share accounts where they have way more. They've got like 40 or 50 different holdings. Um, and I think I'm in kind of a medium range with 13 different holdings. And then some people I've seen, they say, oh, I only have two or I only have four that I like. And we'll just see over the next 12 months, how I move things around and stuff. I don't feel that likely to sell any of the positions that I have. I did sell the one it was kind of like these, but it was even higher risk, and I did not like the direction it was going. Seemed like a bad choice, so I sold out of that one. That was the one that brought in the $100 dividend payment. It was like 180% return or something, but the fund itself was just really going down. I didn't like that. Um, so that's the fund. 13 different holdings. Maybe as I can switch my auto buys to concentrate more on safer ones. This grouping at the top that seems to be doing well. Um, Sometimes when I see holdings that have gone down, oh, sorry about that noise. If you heard a noise from the computer system, um, sometimes if I see one go down in a week or a day, I'm a little bit more tempted to buy those because be better to be buying more of funds that are at a low point or a dip rather than buy more of ones that are already up. But main thing is this chart on the right is trending upwards. Hopefully by the end of the month we hit $250, and we'll see if that keeps trending up and to the right through the rest of the year. Thanks for being here. Subscribe if you want to keep following this portfolio. And if you see any funds that I'm missing that I might not be aware of, let me know in the comments. So thanks for being here.